Guys, we have more point from our colleagues. Apologies, I didn't see your hand up, so I just assumed that was the last of the comments, but would love to hear from you also.
Thank you. Then we will make it very short, but like I actually wanted to make comments on some of the key takeaways, particularly on Deborah's presentation. You know, of course, it has bring to light numerous financing instruments that are out there. But what we actually realize, the countries need some skills to actually be able to make use of all this array of instruments that are there, the financing instruments. We saw the SDG ones, EDG, green, social, environment, sustainable, blue, greenwash. You know, we came to learn about the greenwash and so on. And then the issue of the swap, I think from the last comment, the treatment by the rating agents, I think it's a concern. You know, would be a concern for countries if you carry out some of these kind of transactions. So where rating agents will, you know, tend to downgrade you for carrying such a transaction. So that is a problem, you know, for countries, and it can affect your other instruments that are not even related to this. Perhaps your conventional, traditional ones can be affected in terms of market response to them. So one other thing for the swap, I think yesterday it was made clear that you know, for the interpretation, you know, we don't have to see it as you know, a form of relief, debt relief, or so. It is, I think yesterday we learned that it should be considered as debt conversion. So because it's like you still pay. It's like the method, you don't pay to the original, of course, the creditor. Of course, you direct it to maybe for health or education or something. You know, that actually is going to benefit the debtor. But like its treatment, I think that should be also understood. It should not be treated as, you know, restructuring or kind of, you know, some other things other than to be seen as debt conversion. So it's still debt that you are dealing with, you know, as you have agreed with the creditor. I think those are, you know, some of the takeaways which I believe the players in this space need to take it up, particularly with the credit agents. We saw this in the SCDIs, also how when you call a trigger, so some credit agents are seeing it as a form of distress, you know, and affect your rating. Which these are all financial engineering. There's financing debt instruments, which for countries to make use of them freely to advance, you know, their economies, rather than, you know, for them to be downgraded and become so costly. Going into them will cost you instead, you know, on other instruments. Thank you.
Thank you so much for that valuable contribution. I think, yeah, we're good to start now. Thank you.
Hello, everyone hears me. Well, good morning, everybody. My name is Ian Clark. I'm a partner at the law firm White & Case. I'm joined today by two of my colleagues, Melissa Butler and Demetrius Lyritsakis. The three of us are capital markets lawyers who have been engaged in many debt transactions across Africa. And as Melissa told me a moment ago, we should say from A to Z, from Angola to Zambia and many in between. We are involved in both sort of new issues and also liability management and ultimately restructuring transactions as well. So I think it's for that reason that Nicole asked us to prepare the debt guide on what we call pre-crisis debt management and crisis debt management, because we've seen a lot of that. Now, Nicole did ask me to do a song and dance before starting today's presentation, and I'm afraid I'm not going to oblige, but I'll hold out the possibility before the next one of a little surprise. So that'll get everyone to come back for the crisis management session. The format that we're going to use today is maybe a little different than some of the other presentations. The three of us are going to alternate discussing various topics that are relevant in this first session to pre-crisis debt management, and then in the second session, crisis debt management. At the end of our remarks, I think we'll leave some time for questions. We're going to cover a lot of territory. We're going to have some case studies later on, particularly in the context of crisis debt management. So I suggest we just get started, and we'll look forward to engaging on some of these important topics. So to start, we've all heard over the last few days about the different categories of sovereign creditors and instruments that are used in sovereign finance. You know, debt is plainly a very important tool of public governance. It facilitates development and growth. It helps deal with gaps in expenditure and helps smooth the economic cycle. And as Yanis has said, it's very much a public good. It's also a big responsibility. And those of you in the room today from debt management offices across the continent, you know, are charged with responsibility for managing this important public good in the interest of your respective countries. There's a range of financing tools that are available to you, ranging from loans and bonds to much more sophisticated instruments that we've been hearing about, the SCDIs, ESG instruments, debt swaps. There are lots of tools there, and you have to have the systems and structures to use the tools appropriately. So as a quick recap of the sovereign debt landscape that we are dealing with, we have two broad sort of segments of creditors. We have multilateral creditors who are treaty-based, who lend primarily on a policy basis, generally on concessional terms. They're historically a very important part of the lending to low-income countries, particularly in Africa. Second category, as we've heard, are an intermediate category, perhaps. There are also generally treaty-based organizations, the plurilateral creditors. Their focus tends to be more regional. You have, you know, Africa-focused plurilaterals, and their lending is not necessarily strictly on a concessional basis. It may be more akin in some cases to the commercial terms of financing, but perhaps in situations where the commercial lending is not available. Bilateral creditors we've heard about. We have the Paris Club and non-Paris Club. For many years, the Paris Club was the source of most financing in Africa. In recent years, certainly the last 15 years, we've seen new non-Paris Club creditors, including creditors like China and India, becoming much more prominent on the continent. Then over on the private sector side, we have commercial lenders who are banks and financial institutions generally, and bondholders. And bondholders can comprise holders of international instruments, ISBs or international sovereign bonds, or domestic sovereign bonds. So I thought I might just start with a quick sort of overview of who are your international bondholders, because I think that will inform to some degree how you will be dealing with them in the course of debt management. In the primary market, you'll be primarily dealing with what we call real money institutional investors. And these are investors who primarily buy instruments at par. They are what we call buy and hold investors. They're generally interested in instruments governed by international law. New York or English law is most common. Many of them are what we call index tracking investors. So they will, if a particular instrument is in the emerging market bond index, they have an obligation to hold it in their portfolio. You might contrast this class of investors with a second class that you may be dealing with, which are secondary market investors. And these are investors who may be distressed investors. They may be interested in buying assets at a lower price and managing their exposure. They may be interested in certain sort of macro plays. They provide liquidity in the secondary market, and they are really a very crucial underpinning of the international sovereign bond markets. Without them, you couldn't have the primary investors at par, because they need to have investors to whom they can sell their exposures in certain crisis situations. So I think with those two sort of segments of bondholders to think about, it is interesting to just take note of the evolution of the creditor landscape in Africa. As I said before, multilateral and private Paris Club creditors have still have a very great significance on the continent, but now we do see, particularly in recent years, and because of the low interest rate environment, we see much more Eurobond debt, international instruments that have been used not only by medium income countries, but by a lot of low income countries as well. We've also seen a rapid evolution of domestic debt markets in Africa. And that's provided an additional tool for debt managers to employ in managing debt exposures. The recent, most recently, and sort of the baseline from which we're starting is, a rapid accumulation of debt across the continent for a lot of reasons that we're all familiar with. COVID, fluctuating energy prices that impact both commodity exporters and importers, the impact of the Russian-Ukraine war, and the change in the global monetary conditions have all contributed to an accumulation of debt. And this has put a premium on good debt management. So now Melissa is going to talk a little bit about debt management tools that are available to the relevant officials to manage these exposures.
Thanks, Ian. This is going to be a long conversation about tools, but a very short conversation to introduce it, really. I think a lot of you are here precisely because your debt management offices are being soundly run. Obviously the foundation of the foundation of being able to avoid a crisis is ensuring that you have the right institutional architecture and systems in place to prevent excessive debt accumulation and to avoid a potential scenario when the country is in distress that the debt also goes in distress. And this starts with the legal framework and with the debt management strategy that a country may pursue. Now, there's obviously a lot of infrastructure. There's a lot of guidance on this type of things, and I imagine that many of you, in fact, are beneficiaries of some of the technical assistance and that the World Bank and IMF and others provide, as well as ALSF and other organizations. So, it really is the bedrock of any of building the institutional capacity to address debt distress issues when they come on board. And then the next one is obviously, it feels a bit obvious, but it's sometimes harder in practice, but sound debt incurrence and debt management policies. And appreciate that oftentimes this it can be out of the control of the debt management office, and subject to political pressure, despite having the right perhaps policies and guidance on this. But we think nonetheless, a strong and confident debt management office that is able to articulate, the reasons why prudent policies here to the politicians and to the other policymakers in government is absolutely essential. As is monitoring debt and risk management, looking at the different types of debt and how it may evolve over time, how the currency changes, how the interest rate risk changes as macro and other factors start to impact the debt stock. It's a continuous process of debt management, and not one that is looked at simply upon incurrence of the debt. The last two, just want to touch on briefly. This is going to be fundamental, really, when looking at avoiding any kind of debt crisis. This is the issues around debt transparency and investor relations, right? Debt transparency, and it can be tricky, and Demetrios is going to talk about it in a little while, but issues around, you've all probably got loan agreements that have confidentiality provisions that restrict your ability to talk about certain facilities or terms in it, or even sizes. But we would encourage you to put at the forefront of all of your debt management when you're looking at debt incurrence is the issues of transparency that may arise, being able to be fully to disclose fully to all of your creditors, official, bilateral, multilateral, what your debt stock is, and the health of your the debt situation in the country is going to be very important in instilling confidence in the country and in the policymakers. And hand in hand in this is investor relations. This is obviously communicating with your investors. I'm sure you probably get visits from your the banks that you work with, and the multilaterals, and for those of you that have issued bonds, even the bondholders. We would encourage you to be fully transparent, to reach out to them, to issue guides on the amount of debt that you have, and the evolution of what is happening with that debt. Certainly, it's something we see on the new issue side. Whenever we bring an issuer to the bond markets, the better the disclosure on the debt, the better the reaction you get from investors. The more clear and articulate you are about who your debt, who holds your debt, how much you have, the different tenors, maturities, coupons, all of this is really important in instilling investor confidence in you and in your securities. And I think the reaction from an investor base when they see a very transparent, open debt management office is very hugely different from when you see one that is not as transparent. So I think with that, I will turn it over to Demetrios, who's going to cover around the next section.
Yeah, thank you, Melissa. I think now we can speak a little bit about designing debt structures at the pre-crisis stage, so that the sovereign can really put itself in the best position to deal with a crisis. And we spoke the other day about SADIs, which are instruments that are designed to be resilient. Their commercial terms are designed to be resilient to shocks and to smoothen out potentially the commercial impact when there is a crisis. What I'll be speaking about now are the legal terms and the legal design of certain instruments that have to be taken into account at the pre-crisis stage in order to mitigate the effects of the crisis. And in contrast to the commercial SCDI terms, legal terms are not very they're not very attractive. It's not reading that you do over the weekend, right? Aside from lawyers, no one really likes reading contractual provisions in Eurobonds, for instance. But it's something that I think absolutely needs to be undertaken as an exercise, because it's no secret to us here that It's contractual terms that really define the relationship between a sovereign and its bondholders over the life of the bonds, and particularly at a time of distress. And I'll speak a little bit now about Eurobonds, and then Melissa can speak about other debt structures, and then we'll go a little bit back and forth. But in terms of Eurobonds, it's really the contractual terms that define the chemistry of the sovereign and bondholder relationship throughout the life of the bond. In the absence of a sovereign insolvency regime, they actually also determine the contours of the sovereign debt crisis resolution. They define the bargaining power between the parties. And in that sense, they are absolutely critical in your toolkit when you're evaluating potential risks and assessing different options when it comes to treatment of Eurobonds. And as Eurobonds have become more prominent forms of financing over the years for many countries, the terms have evolved really to offer both the sovereign and the bondholders various protections and assurances in order to make those instruments marketable and to make them attractive financing options. So from the bondholder perspective, bond terms have evolved and have been designed to mitigate the risk that a sovereign will choose to default on its debt when it is otherwise able to pay. So in that respect, bonds include clauses that really increase the cost of default for a sovereign. And these broadly include three categories of clauses. They include events of default that lay out the circumstances and occasions when a default is triggered under the bonds, so that there's full transparency and everyone knows exactly when that has happened. Events of default include payments, events of default that determine when a missed payment constitutes an event of default, and usually there's grace periods applicable to missed payments, and those are very important because, again, they define when exactly you're in default. They include cross-default and cross-acceleration provisions, which effectively provide that even if you're current on your Eurobonds, if you have defaulted on other debts, then that can cause a default under the Eurobonds as well. And that's very important to know when that has happened, because it leads to various contractual consequences. Oh, anyone can hear me? Should I repeat what I've been saying for the last 5 minutes? Aside from events of default, there is clauses that limit the ability of the sovereign to provide preferential treatment to a subset of its creditors. And those include the infamous pari passu clause, which is most likely the most notorious contractual provision in sovereign bonds. And I will spare you the 15 years of litigation over that clause that ensued in Argentina. But effectively, the pari passu clause provides for equal treatment among different classes of debt. And it provides that effectively a sovereign should rank different classes equally, which in essence means that the sovereign cannot subordinate, legally speaking, one class of debt to another class of debt. In the same vein, there is the negative pledge clause, which provides that a sovereign cannot provide security to a subset of its creditors without at the same time equally securing the Eurobonds that contain the negative pledge clause. And then last but not least is the enforcement clauses, which really deal with enforcement. And these are, it's a number of clauses that relate to enforcement. Most importantly, it's a governing law and the submission to jurisdiction. And when you issue bonds in international markets, your bonds are usually, or always in fact, governed by foreign law, and the sovereign submits to the jurisdiction of foreign courts. And the reason for that is that this provides some credibility and reliability in the resolution of contractual disputes. At the same time, there is acceleration provision, which apply when an event of default has occurred, and provides that if an event of default has occurred, a certain number of bondholders can declare the full amount of the bond, the full principal amount to be due and payable. Then there's also specific enforcement provisions that provide individual rights to holders to sue the sovereign upon various defaults. And all of those clauses, while in some form are omnipresent in sovereign contracts, provides that even if they're very much differ in their scope. So that's why it's very important to be doing a specific analysis of each clause to see what is the scope, what is covered under each clause, and how much protection does a clause afford to bondholders or the sovereign. Generally speaking, the more limited those clauses are, the higher the protection that they offer to a sovereign. So this is the perspective from the bondholders. Of course, bonds have also developed to provide protections to the sovereign, particularly with respect to what's called the renegotiation problem, which means to really minimize the risk that a sovereign will be unable to renegotiate the terms of its bonds in circumstances where it is actually unable to pay. And I will pass it on to Ian now to describe a little bit how that works.
Thanks, Demetrios. Yeah, I mean, one of the key considerations for any debt manager is how to deal with a problem in a certain credit facility or in a certain debt instrument. How do you make the necessary changes from a legal point of view? And it used to be very straightforward to do so. I mean, when you were dealing just with multilaterals or just with your official creditors, or even just with banks under bilateral lending facilities, you knew who you were negotiating with. You could approach them, you could explain your situation, and you could secure the necessary changes. With the introduction of bonded debt, where your creditors are no longer a known quantity, but are now an anonymous group of institutional investors who are sitting at their desks thousands of miles away, you no longer have the ability to just pick up the phone and secure these types of necessary changes in the ordinary course of debt management. So various tools have developed over time within the context of the Eurobond market to help sovereigns address this problem. Which is we call sort of the collective action problem. It's impractical to go to get the consent of every one of your bondholders if you want to change something. So over time, the Eurobond market has developed certain conventions. And the key innovation, if you will, was the introduction of qualified majority voting, which is to say, material terms of a bond instrument can be changed with the consent of a supermajority of creditors rather than all creditors. This has long been a feature of English law instruments. It's now also a very common feature in New York law governed sovereign debt instruments. And this takes us part of the way because it means that if you are making changes to payment terms, if you're making changes to key contractual provisions that affect the creditor's rights, events of default, governing law, place of payment, currency, if you need to make these types of changes, you can go to your creditors and solicit their consent, and 75% majority under an individual bond instrument can normally achieve an amendment that will be binding on 100%. Less significant changes or changes to terms that are not as material under these same conventions can be achieved with a lower majority of bondholder approval, say 50% rather than 75%. Now, these were what we call the first generation of collective action clauses, and they applied instrument by instrument. But as a debt manager, you may have multiple debt instruments in your portfolio. And then the question arises, how do you most efficiently deal with changes across the whole spectrum of bonds that you may have outstanding? In 2014, ICMA developed a new generation of collective action clauses called the so-called aggregated collective action clauses, or aggregated CACs. The key innovation that these offered were that an issuer could solicit the consent of bondholders across multiple series of debt. And if a certain qualified majority of bondholders across all of those series agree to the change, then all of the different series are bound. And the advantage here is that you may be able to secure amendments of debt, notwithstanding that in one particular series, you may have a larger proportion of holders who are not agreeing. Now, the second interesting innovation is that a second type of consent was also created, called a two-limb aggregation. And without spending too much time on the details, it allows a lower supermajority to agree to a consent as long as you have at least 50% support in each series. And again, these tools, the aggregated CACs, were designed to facilitate better debt management and have been very widely accepted across the capital markets. So as a debt manager, when you're looking at your new issues, and indeed you're looking at refinancing existing bonds, it's very important that you ensure that these types of clauses are incorporated in your new instruments to facilitate future liability management. Now, the one other point that I'll make in terms of the sort of the management of changes in bonded debt relates to domestic bonds. You know, one of the reasons why this is a potentially attractive instrument to sovereigns, particularly facing challenging conditions, is that there's always the possibility of changing domestic law that will have the effect of changing the terms of those instruments. And this change of law risk, if you will, does not exist in international sovereign bonds governed by English law or New York law. It is one of the reasons why many international investors only want to invest in the latter. They feel too exposed and would require too high a risk premium if they accepted local law governed debt because of the risk of unilateral change of law by the issuer, which can affect the contractual terms. So now I will pass it over to Melissa, who will touch on some issues relating specifically to secured debt and guaranteed debt.
Thank you. Yeah, just real quickly, I think because this has probably been addressed at other times during the course of this week, but obviously, looking at kind of structures that have some kind of security, collateral, or other credit enhancement can be very attractive when you're looking at the markets. It can be a good way to monetize assets or revenue streams that might otherwise not be producing money or might be a good source of revenue. Security can improve market access or improve coupons, all of which, when perhaps alternative sources of financing are not available, do seem, are very attractive options and should be considered. But there are potential pitfalls in the event of a debt distress situation that you should be aware of. With this type of debt, because it can, when a country does go into distress, oftentimes the asset that might have been secured might have been a valuable source of revenue or financing that the government is no longer able to use because it has been secured to a third party. It may also disincentivize any other type of, rescue creditor or lender who may want to come in and provide financing to you, but realize that the assets that might have serviced that debt are secured to a third party. So it can disincentivize that participation, again, at the time that the country might need it most. And thirdly, you should really think about the risk of attachment or enforcement on those assets in the event of default, right? Not only in the event of default, not only because there's a risk that they might actually enforce on that asset. Obviously, that's a real risk, and it changes the negotiating position of the parties, right? If a creditor has access to security, then they're less likely to come to the table and negotiate with you on improving the terms of their debt, because they have at least the threat of enforcement on that asset that they can use against you. And that obviously puts them in an entirely different category than creditors who might not have any type of security. So we would want to just raise that flag that you should be very cautious when looking at any kind of security or credit enhancement. Another obviously important consideration is what's commonly referred to as the World Bank negative pledge or other contractual provisions that might restrict your ability to secure, or might restrict your ability to secure debt without providing similar security on the other debt that you might have with other lenders. So that is something you should be aware of, and have your legal advisors review your contracts to ensure if that is actually even legally possible. Another category that we want to talk about in terms of kind of alternative debt scenarios would be credit enhancements. So this would be things like full or partial guarantees from third parties. For example, the IDA guarantee of Ghana's Eurobonds from a couple of years ago. Or even, as you discussed yesterday, the Gabon debt for nature swap. Again, it's a type of security enhancement or credit enhancement, allowing Gabon to secure debt that they might not otherwise have been able to obtain. Now, again, very innovative, very interesting instruments that provide market access, that provide better coupons or provide a new source of financing. So all of them should be, seriously considered. But you do want to think about the consequences in this type of debt that it's similar to debt that might have security. That in a times of restructuring, the negotiating positions of these creditors change. Right. So, for example, if you look at the Ghana World Bank guaranteed debt, Ghana has a number of different Eurobonds outstanding. Deciding to default on the Eurobonds means that the Eurobond holders need to come to the table and discuss with Ghana how it's going to restructure its debt. Now, if you look at it from a position of a bondholder who owns a debt that's guaranteed by the World Bank, what's going to bring them to the table to negotiate if they've got a guarantee? Right. And then if those holders are call on that guarantee from the World Bank, who are you now negotiating with? Who's your counterparty? Right. It's the World Bank. And the World Bank, what do they have? Right. They have preferred creditor status. So that means you have to pay them. So you have this situation where you end up with a very different negotiating position on the different creditors, even though it looks like bond debt. It looks like it's held by bondholders. In theory, it should be similar, but the actual negotiating position of the parties is very different. Now, again, this is not to say that you shouldn't look at these types of instruments. They definitely have a lot of value, but you should be aware that there can be consequences in the event of a future situation of debt distress. And now I think Dima is going to talk to us about comparing bonds to loans in the restructuring.
Yeah, thank you, Melissa. I will not go in so much detail as to compare bonds to loans, but I think I will just highlight a few elements in sovereign loans that in and of themselves might not seem as critical or as problematic, but when you see them from the spectrum of their place in a comprehensive sort of debt management exercise, that's when they become particularly important. For instance, these elements that I will mention, if loans were your only sort of financing and you had no other debt, those wouldn't be an issue. But in a context where you have bonded debt and you have official debt, then those provisions potentially create a lot of problems down the line. And those include confidentiality clauses that Melissa briefly mentioned earlier. They include clauses that provide for preferential treatment or preferred creditor status, or otherwise acknowledge that a lender will receive some sort of preferred treatment in a restructuring. And they also include collateral or, security or quasi-security clauses. So all of those in and of themselves are innocuous if you have no other debt, but within a context of an evolving and complex landscape, they become very problematic. Confidentiality clauses are problematic both at the pre-crisis stage and at the crisis stage. At the pre-crisis stage, they can really inhibit your ability to be transparent about your debt stock, the kinds of debts that you have incurred. So that really inhibits your ability to have a robust legal framework for managing your debt at the pre-crisis stage. At the crisis stage, they become even more problematic because really they inhibit negotiations with other creditors, because other creditors then negotiate in the dark. They don't know what the terms are of the loans that you have incurred, and they don't know how those compare to the ones they have. So that can create a lot of complexities and delays in a restructuring process. So broadly speaking, you should be paying careful attention to confidentiality clauses. You should be thinking whether those are reciprocal, meaning whether they protect the lender and the sovereign, or whether they are sort of unilateral, protecting one of the two. And for the most part, if you have the choice, you should avoid including them, or at least avoid including reciprocal clauses, but only include confidentiality provisions that protect the sovereign and prevent the lender from disclosing information under the loan to other lenders. When it comes to clauses on recognition of a particular status, we see those more and more in various types of loan contracts. And effectively, they try to really mitigate a crisis, and they try to contract for really an exclusion of this particular loan from the debt perimeter at the time of crisis. This should generally be a no-go. There is no good reason to include such provisions in a debt contract. Generally speaking, preferred creditor status is not a contractual provision. It is not something that is codified. It is for the most part only based on market practice and on historical practice. So there is no good reason really to include those in a loan contract. And I will not go into much detail about collateral and quasi-collateral. Those have been discussed at various times in the last few days. But generally speaking, even if you don't have collateral per se, having quasi-collateral arrangements in a loan that include reserve accounts that are offshore and that have to be funded and so on, those create lots of complications at a time of crisis. And while many lenders might require those sort of arrangements in order to lend, you should pay very close attention as to how those are structured, to understand when the accounts have to be funded, with what funds, how much flexibility you have to not fund those accounts at the time of crisis, or to change the arrangement at the time of crisis. So those are just issues that, again, in and of themselves, they wouldn't pose much of an issue, but in the changing landscape that many sovereigns experience now, those become increasingly important.
Thanks, Demetrios. I think now we want to turn to a couple of topics that relate to what we might call liability management tools. And I'm going to just speak for a couple of minutes about a couple of techniques that are available to debt managers to manage the exposure, particularly with respect to Eurobond debt. Obviously, the goal of good liability management and of a debt manager will be to optimize the structure of your debt portfolio at any particular point in time. And that may mean looking at the choice of different categories of debt that you have in your portfolio. You may want to have a mix of concessional debt at attractive terms, but with heavy conditionalities, and commercial debt, which may be more expensive, but give you more freedom to use the proceeds as you see fit. Obviously, we've heard about the risks of having excessive FX denominated debt in your portfolio, the risk of currency movements. With respect to Eurobonds, you will also have some choices to make, and two techniques that you can use to manage your exposure to Eurobonds that you've already issued are first of all what we call debt buybacks, and second of all exchange offers. So first of all, debt buybacks. Even if by their terms, a debt instrument is not callable by the issuer, in other words, cannot be mandatorily repaid, there's still an ability of the issuer to go into the market and purchase those securities from the existing holders. And this can be done either by way of private transactions, where you simply commission a broker or other intermediary to buy debt in the market, or it can be done through what's called a public tender offer, which is a much more involved procedure. With respect to the private transactions, this is often attractive, particularly if your debt is trading at a discount to par, because you may be able to go into the market quietly and purchase bonds at, let's say, 90 cents on the dollar or 85 cents or even lower. And so long as the rules of the market where those securities have been placed are followed, then this technique can be used to quietly retire some debt at below par. Now, there are legal restrictions imposed by many jurisdictions. The U.S. markets and European markets all have restrictions on the ability to perform these types of operations without disclosure. So, as a rule of thumb, you can perhaps retire 10% of your debt in a particular series this way without making public disclosure. So it's a useful tool, but you can't use it without having an awareness of the legal restrictions. Now, public tender offers will allow you to, in a more public and structured way, approach all of your bondholders with an offer to repurchase the bonds. And there are a multitude of different structures that your banking advisors will inform you about as to how you can do this. You can do offers at a fixed price. You can organize reverse auctions to try to negotiate a better price for the tender offer. It can be for all of the bonds. It can be only for some of the bonds. There's a lot of flexibility in using this tool. But of course, the disadvantage is you're doing this in a public way, and by the mere fact of doing the transaction, you may affect the price of the instruments. You may not achieve, the same capturing of the discount that you are able to receive in a private transaction. The other tool that I'll mention briefly are exchange offers. These are offers that are made to the market, not for cash, but instead to exchange the existing instruments for new instruments. Now, this is a very useful tool. For example, if you're looking at the average life of your outstanding bonds, you want to extend the average life by replacing a short-dated instrument with a longer-dated instrument. It could be replacing an instrument one currency with another, replacing floating rate instrument with fixed rate. There are a lot of different reasons why an exchange offer may be a good tool to use to offer, instead of cash to retire an existing bond, to offer another instrument instead. This is a more elaborate process and subject to securities rules and regulations in a more detailed way than the cash tender offers I was describing earlier. But many of the institutional investors that I mentioned earlier, are very familiar with these exchange offers. They're attracted by them because they want to maintain a position in your debt in their portfolio. So they may be, very interested in participating in these transactions on attractive terms. Now, one of the tools that is possible to use when you're doing the exchange offers is to ensure, as I described before, that you include in the new instruments maybe updated clauses, legal clauses, some of the ones Demetrius was talking about, or ones we've been hearing about this week, that may not have been in your legacy debt. So, for example, if you have old style collective action clauses, not the most modern ICMA aggregated collective action clauses, you could introduce that concept in your new bonds. You could introduce climate resilient debt clauses. There are a number of different tools that you could incorporate in your bonds using the exchange offer technique. Now, the exchange offers that we're talking about here and the debt buybacks, these are non-distressed transactions, which is to say you're convincing investors on market terms to take part in the transaction. So a little later in our next presentation, we'll talk about distressed exchanges, which have some very different features and incentives than these. But here you have to offer something to the investor that makes it worth their while to replace their existing debt stock with the new one, or to accept the cash offer. A cautionary note that I think Melissa will talk about in due course is that rating agency treatment of the debt exchange needs to be monitored very carefully. You don't want it to be in a position where inadvertently, by the terms of your exchange, the rating agencies will look at the terms of the transaction and conclude that this was a distressed exchange that would then change the rating categorization of the issuer, perhaps even into selective default, which can have obviously lots of other implications. Demetrius, I think, will now talk a little bit about consent solicitations, which are another tool of liability management that can be used in the ordinary course.
Yes, thanks, Ian. I will very briefly speak about consent solicitations. Consent solicitations can be used to achieve pretty much the exact same objectives that Ian was outlining, particularly with respect to exchange offers. And the difference is that instead of inviting your bondholders to exchange their existing instruments for new instruments with slightly different terms, you just invite your holders to amend their existing instruments through the voting provisions in the existing instruments to implement the same changes that you would be implementing with an exchange offer. And for the most part, the changes that can be made are extending the maturities, smoothing perhaps the repayment profile. You can include amortization clauses and so on. You can change the interest rate structure. You can change the currency structure. But as Ian was saying, the key part here is that all of this has to be done in a voluntary way. So you will need the consent of the requisite majorities of the holders under each instrument to implement those amendments. And because they're not done in a distressed situation, they're always NPV neutral or NPV positive. So, and they're most usually NPV positive because you want to incentivize your holders to participate in this endeavor. So many times you will include consent fees and other incentives of that nature to induce higher participation. So I think I will leave it here. No need to go into the ultra technicalities of the process. And I'll pass it on to.
Yeah, last topic, and then we'll open up to questions. Just as Ian mentioned, the issue of ratings, right? Ratings are hugely important. It allows the market to give an objective comparison of different issuers. It allows them to understand how to price different risk. And I'm sure you're all very familiar with that process and why it is so important. But it can be a real problem when you're looking at some kind of potentially non-distressed exchange or a liability management transaction designed to prevent a distressed debt situation. I think, as Jill mentioned earlier, sometimes the most well-intentioned transactions can end up becoming a selective default. And this is where a rating agency makes a determination that you're undertaking the transaction in order to avoid a payment default. Right. And they have a wide discretion in how they apply it. So you might think, okay, well, look, we've got some issues, some liquidity issues. Let's just extend the maturity of our bond, or let's change some terms. This is for our bondholders want us to do it. They're asking us to do it. It makes sense for us. And then you think that this is a great idea, and then the rating agencies tell you, well, if you do that, we're going to declare you in default, right? It's a real problem. The market is trying to address it, I think, as Jill said, because it does seem to prevent this. The liability management is one of the most useful tools for preventing a default, right? And for preventing a formal a debt crisis. However, the way that the rating agencies have interpreted it has really spooked issuers from their ability to actually engage in these transactions in an active way of managing their liabilities. And we think it's a real shame. And I think, again, as Jill said, you should consider whether or not you're okay with the rating agency consequences, despite what they come, because they might be better than the alternative, which might be a full-blown default. So again, before we move into our next session after the break, I think where we'll actually talk about once you've gone into default, we would encourage you to actively look at liability management transactions if you are in a distress scenario. And then I think with that, we'll open for questions.
Thank you very much for the presentation. I tried to, want to ask on this, the last part, the liability management. So where Ian was saying like it should be a NPV neutral or positive, but you do see cases and also it should be voluntary for the creditors. So we do see cases in which, do you have cases wherein it will not be liability neutral? Was like perhaps they will say extending maturity, but at the same time they want reduction on, rate of interest. So I believe that may not necessarily be neutral, because and then do you see such cases, and then this being voluntary, could it lead to success? Because if they are not wanting to come in, voluntarily, how do you get them in, because you are facing crisis and you actually want this to take place, and this is voluntary, and in cases there might be situations where it might not be liability neutral or positive, So how do you deal with such circumstances?
Okay. Yeah, I can address this one. Then you guys can chime in. I think the circumstances you're describing are more akin to a distressed exchange, and of course they do apply in a time of crisis. We will be speaking about this in the next session. But generally speaking, if you are requesting a reduction in, say, interest rates, then that is a sign that you're actually dealing with a distressed situation. The liability management tools that we were describing now that are NPV neutral are just intended to change the structure of your debt without changing the payment terms per se or the NPV of the structure. So effectively, you can change the structure to make it, to improve it from a liability management perspective, but without actually imposing any losses on the bondholders. When you have to impose losses, and in fact, many times you do, that goes into a distressed sort of exchange and distressed liability management, which is the topic of the next discussion.
Yeah, I agree with that. The one thing I would say is that sometimes you might have a situation where bonds have been issued, let's say 5 years ago, but they have a 7-year maturity. They were issued under a very different set of macroeconomic conditions. Global financial conditions may have been different. And at the time, the coupon of that instrument was, let's say 8%. And because of changes, maybe an improvement in the creditworthiness of the issuer, maybe because of a compression of yields in the market, for you to exchange that instrument for a new instrument at 6% will provide a similar yield to the investor. They will feel that they're holding an instrument of similar value to the one that is being exchanged. So there is some dynamic here, of course, that it doesn't always have to be the same coupon or higher. You're looking at a whole complex set of factors that weigh on whether the yield to investors is better or worse than with respect to the instruments they previously held.
Thank you very much. I feel much comfortable this morning because you're talking sound debt management practices here. And so my question is just on domestic bonds. And how are they? Because in South Africa, we have a clause in our Public Finance Management Act that say it forms a first claim. Any money government borrows forms a first claim against the National Revenue Fund. So in a case, so it means that before government pays salaries or whatever, it has to honor its debt. Isn't that enough protection, or could that also be problematic in case of a crisis? Or I was just thinking, that for me is a very solid sort of undertaking, if I can say it like that.
No, thank you. And I think that's, that's a very interesting point. Obviously, domestic legislation in your case provides a very solid protection for bondholders as first priority creditors. But the scenario I would offer to you is precisely the one that occurred in Greece in 2013 when they restructured their debt, which is the existing legal framework was not suitable for them to restructure their debt. And so they changed the law, and the law applied retroactively to instruments that had already been issued by Greece. This was subject to some legal challenge, but ultimately the change of law incorporating, in that case, collective action provisions into the domestic debt instruments, where those collective action provisions had not existed before, that was found to be, enforceable from a local and an international point of view. So in your situation, there still remains the residual risk that South Africa finds itself in debt distress and decides to override that piece of legislation with fresh legislation that may be legally effective, it may not, but there is still some incremental risk that could happen. Yes. So a question from Slido, a little bit more about the collective action provisions put in place by ICMA in 2014. The problem in 2014 that ICMO was trying to address was the issue of holdout creditors. They were concerned that the single series collective action clauses that were very common in Eurobonds at that time might not be sufficient to ensure the broadest possible base of participation in a sovereign, particularly in a sovereign debt restructuring context. And the reason for that is if you have, let's say you have two series of bonds, and each of them can be amended with 75% consent in terms of the, say, key payment provisions, it would be possible for, 25% plus one of the bonds to be held by an investor who could then block the restructuring of that series. If you had aggregation across the two, then you would not necessarily be sure that you could block a restructuring by holding 25% of the one series, because if 75% could be achieved across the two series together, then the amendment could be pushed through. And this would make it harder in the view of ICMA for holdout creditors to pursue successful strategies to hold out in a restructuring for better terms than the majority of creditors were prepared to accept. So this clause was a bit controversial at the time, but in fact, in practice, in the sovereign restructurings we've seen since 2014, it's been very successfully applied. We've seen, in fact, very little creditor litigation and successful holdout behavior since the introduction of the aggregated CACs in 2014. So this is why certainly our recommendation, as advisors to issuers, but indeed even as advisors to bondholders, is that introducing these clauses into bonds tends to generate good collective outcomes in distress situations and minimizes the risk that certain creditors will hold out for better treatment, pursuing a successful strategy to that end.
Should we address the other questions? We have some time, Nicole? Right. Yes. Or vice versa. Yeah. How useful is a pari passu clause to the issuer? On its face, it's not useful at all. On its face, the pari passu clause is useful to the bondholders because it provides that the issuer cannot really discriminate legally between different classes of different types of debt. However, different formulations of the pari passu clause provide more flexibility to the issuer to potentially treat different classes of debt differently. For instance, a typical pari passu clause might say that the bonds rank pari passu with the issuer's other indebtedness. That includes bonds, loans, official sector debt. Or it might say that the bonds rank pari passu with other external debt, which only includes foreign currency, foreign law obligations. Another variation would be to say that the bonds rank equally with public external indebtedness, which means that really the bonds rank equally with other bonds. And there's some variations of the pari passu clause that even provide that notwithstanding the equal ranking and the equal treatment, the issuer can actually afford preferential treatment by virtue of mandatory applicable law, which in some occasions means domestic law. In fact, in Ukraine, that clause was embedded in the contracts and provided some flexibility to the Ukrainian government to implement legislative provisions that indicated that different debts could be treated differently, and that was used as an incentive to participate in the broader exchange offer. So on its face, it's a creditor protection, but nuances and variations in the wording of the clause can ultimately be to the sovereign's advantage. Although I will also say that the ICMA, the International Capital Markets Association, has now come up with the standard form of this clause that is included in most modern sovereign bonds. And the clause expressly provides that the pari passu clause only protects against legislative subordination, and it does not protect, for instance, against rateable payments. So really, the constraint of the pari passu clause is that the issuer cannot legally discriminate between different classes of debt, but they can still pay one creditor before paying another. In other words, creditors don't have to all be paid at the same time. And that was a direct response to the Argentine litigation saga, which had actually come up with this rateable payments interpretation. So perhaps I will leave it there on the pari passu, and I will pass it on to you.
Thanks. There's a question here, and then we'll take one from the floor. Is examples of quasi-secured lending? I think, use your imagination, right? There can be all kinds of examples of what might be classified as quasi-secured. I think probably one of the classic examples would be something like an oil prepayment facility, right? That allows the lender to offtake oil or commodities or whatever asset may be in lieu of cash payment. So in particular, if they have direct access to the whatever that it may be. So those can operate in a similar way to a fully secured loan, in the sense that that even if you do default on payment, they may be entitled to take assets from the country.
All right, thank you very much. Congratulations for your presentation in not too technical fashion. I'm looking at debt, or I'm speaking from financial theorist point, so not necessarily a practitioner. My observation is that, you see, most of these debt are either offered or recommended to the sovereign nations. And primary offer, you find that there's a lot of scrutiny by the usually by the lenders. They ask a lot of questions, and that is what leads to transparency, opening of your book. But to the sovereign countries, most at times what I discover is the in terms of capacity of the negotiators from the borrower. So my first question on this is, given that these debts are usually long time in nature because they are bond, and likely the holder may not, he may not hold those instruments to maturity. So you find that it is sold at a primary market. And most of these primary markets, to the best of my understanding, you hardly found them in the discussion and the contract. Yes, the architectural aspect, the design of those contracts, when they are offered, they are discussed at the borrower's country. But when it comes to the secondary, you will find that you suddenly wake up and find that it's a different party, because the other one, yes, granted that a borrower may not hold the instrument up to maturity because some of them are long time in nature. So my question to you is, how do you fill in this gap in terms of capacity of the negotiators, given that sometimes these contracts are entered into the domestic market and then executed in an outside market? Thank you.
I'm happy to take a go. I think there's a kind of a lot in your question there, but I think, in terms of obviously the initial negotiating stage, as you say, there's a lot of back and forth and a lot of diligence and a lot of information that is shared. I think once the bonds trade in the secondary market, then the information gap is filled in a couple of ways, right? The first we talked about, at the beginning here is through the authorities' own disclosure, right? What they put into the market, what they share with investors. Certainly, if the bonds are listed on a regulated stock exchange that might have requirements that if the issuer is aware of any material price sensitive information in respect of the trading price of the bonds, that they have a legal obligation to disclose that. But I'd say probably the more, is this just general information, right? Countries are almost universally members of the IMF. The IMF reports a lot of information on different countries. There's a lot of information that investors can get, and they follow that quite closely in terms of assessing, together with whatever information the government puts out on its own to monitor the situation. And if it comes to a point where they're discussing again because of a debt distress, then they'll either look to that information or come to government and ask them to give them some additional information. Because definitely, in order to have any kind of constructive dialogue, the two parties need to be on the same page and have the same set of information that they're dealing with.
Merci beaucoup. Thank you very much. I have two questions. You've talked about the guaranteed collateral for the debt. You also presented for the revenue of petrol or oil. You talked about oil issues. And we also have another type where we have a third party that will intervene to secure the lender. And in that case, I do believe that when we have a crisis, the lender or the creditor always have that guarantee in which he can turn to, and the relationship remains between the borrower and the creditor. That's my first comment, not a question as such. And you talked also about the redemption of credit, so to speak, in terms of crisis. But I do believe that when we are too much debts, and when we need to manage the crisis, we cannot talk about I do believe that when we have a comfortable situation and when we have an opportunity, we can rebuy or repurchase that credit so that we can have debt relief. And I do believe that we can classify it in the debt management, dynamic debt management, and not a crisis, because if we are in a crisis, we need to find solution. But in my understanding, it's actually an engagement that we need to have. But when we are in a crisis situation, we need to find solution. That's my understanding. Thank you.
Yeah, and no, two good points. I mean, the first one, yes, obviously the relationship with like an ECA or an insurance on a loan can change the dynamics as well. And that's another kind of interesting product to look at, especially in the debt restructuring context. And your second comment on, just trying to remember through the translation, but the second point on, I'm totally blanked. Did you get the second? What? Oh, the buybacks. Yes, apologies. Sorry. Yeah, on the buybacks, absolutely, it can be a very useful tool in a non-distress scenario, because you'll see, and especially I think we've seen over the last few years that a lot of issuers' bonds are trading below par due to no issue of their own, just because of macro conditions, right? And it's potentially a very good opportunity to go into the market as sound liability management, right? It's a good thing to do. The challenge there is around the ratings. I think deters a lot of people from doing that, even though it is in their interest. The other thing is I think as Ian touched on in his discussion, is that you do need to make announcements about debt buybacks for legal reasons, and when you do that, that can also impact the price, right? So bonds that might be trading lower might move up once you start making those kinds of announcements.
Maybe I'll just touch on a couple of the Slido questions. One question: how can borrowers protect themselves from vulture funds through prudent debt management? Well, the difficulty when we're talking about vulture funds, what we're talking about is a subcategory of the secondary market investors that I was mentioning earlier. These are specialized participants in the international capital markets who are interested to buy debt that is trading at distressed levels and managing that exposure. And they perform arguably an interesting and important function in the capital markets. As long as you're issuing bonds in the markets, you're not going to be able to restrict the trading of those bonds simply to the investors that you like. There will always be a risk they're going to fall into the hands of investors who are holding out for unreasonable terms. How do you protect yourself? Well, it's exactly as I was discussing earlier. You protect yourselves by having these strong collective action clauses in your bonds. And practice has shown that it is only a very small subsection of the capital markets which is constituted by these so-called vulture funds. The vast majority of your bondholders, even when you get into a distressed situation, will be responsible money managers from leading financial markets. And what you can count on is that they will counterbalance through the use of the collective action clauses. They will counterbalance the risk posed by the vulture funds. And that's why we've seen, in fact, very little successful vulture fund litigation relating to Eurobonds. I mean, there have been some cases in Africa, in fact, of vulture funds that have bought up other types of debt instruments and pursued those through the courts and sought enforcement. And that's a sort of another category of problem. But with respect to Eurobonds, we just haven't seen vulture funds sort of disrupting the consensual restructuring process. The next point was simply, can you get a more detailed note on the discussion? In fact, a lot of what we're talking about is in our debt guide. I mean, we decided to do this presentation in a discursive way, but a lot of the information is there. So I'd encourage you to take a look at that in due course when they're distributed. And finally, a Slido question on the transparency of public debt. If the information the bondholder wants are economic indicators, is it responsibility of debt managers? Well, again, we're talking about prudent debt management here. And it seems to me, and I think from the experience that we have had, that debt managers who share information in a transparent way with the market on a periodic basis, maybe organize investor calls every 6 months to update investors on economic and other developments in their country, or are open to meetings with bondholders on a periodic basis. Perhaps they invite delegations of your bondholders and give them presentations or meet them in financial centers periodically. Developing those relations with your key bondholders and a reputation for transparency will then help you as a debt manager when you need something from them. And I've seen this, most clearly demonstrated in the case of Ukraine, which is one of my clients. And in the years since their last debt restructuring in 2015, they've put in place a very proactive investor relations plan where they're very transparent with the market. They make periodic visits to investors. They put information out. So when the war in Ukraine occurred and they needed to go to their investors to ask for a suspension of debt payments on very short notice, the investors were there. They were receptive. They felt that this was an issuer they could trust, and they responded very positively to the request from the issuer. So I think you'll find that good debt management techniques will be repaid in kind when you most need it. I think that would be the final lesson I would leave you with. Is that enough, Nicole, in terms of timing? Or? Oh, we have one last question. I'm sorry.
Okay, thank you once again for the insightful discussion. Mine is in respect of the aggregated collective action clause you talked about. So if some of your legacy debt doesn't have the collective action, aggregated collective action clause, and then maybe a new debt you're incurring has that clause, how will that work in respect of the totality of your, let's say, portfolio? How would that apply? I just want to understand. The legacy debt doesn't have the collective aggregated. Maybe they just have the collective. So how would that work?
Yeah, I can address that real quick. We're dealing with that in some live situations right now. Basically, if the debt that has the aggregation provisions can be aggregated. The debt that does not cannot. It's quite simple. So if you've got legacy debt that does not have the aggregation provisions, then any consent or restructuring process in respect of that debt would need to be dealt with as a single series. But then if you have, one or more series that does have the collective action clauses, then that debt can be aggregated for purposes of voting on a consent.
And I would just add to that, that's it's very interesting because there are many sovereigns that do have some legacy debt from before 2014, let us say, that doesn't have the modern clauses, and some that does. And in distressed scenarios, what we have observed is that where there is holdout behavior, the holdout behavior will congregate in the legacy debt that does not have the aggregated collective action clauses. And sometimes it means that, and we'll get into this a little later, but sometimes it means that some differential treatment has to be offered to the holders of instruments where there's higher holdout risk, namely the legacy instruments without the modern clauses. So this is why it's very important and useful to put the aggregated collective action clauses into all of your instruments if and when you have the chance to do so, because that it removes that specific problem.
Thank you. Sorry for the abrupt ending, but I think that's the end of this session. We'll now go into a break and then come back for the crisis management portion of their presentation. So thank you again to the White and Case trio for that great presentation.